What's going on, brothers, and welcome back to Brotherhood Finance. In today's video, we have a great podcast that is coming up right now. We have a special guest, Kevin Chancellor. He is the CEO of Black Lab Financial Services. He is a financial advisor, a certified Social Security claiming strategist, and he has a multitude of information he's going to share today. Very knowledgeable, very well known in the industry, and this is going to be a great podcast, so I'm excited to get started. Before we dive into it, make sure to smash that thumbs up button down below. Make sure to subscribe to our YouTube channel, leave a comment, and check out all of our links down below, and we'll make sure to leave Kevin's information down below as well. Furthermore, let's jump right into this. How you guys doing today?
I am doing great, man. Thank you guys so much for having me on here. It's a real honor, so I appreciate it.
Yeah, thanks for joining. So let's just dive right into it. So the first question that we have for you today kind of is, what is your favorite retirement plan for the middle/upper class?
Sure. Before we get started with that, we got to do some legalese, and my industry is heavily regulated. So just want to let you guys know anything discussed today can't be taken as legal or tax advice. And also that my services are offered through Peak Brokerage Services, and my advisory services are offered through Black Lab. I'm sorry, not Black Lab, but Blackridge Investment Advisory. And Black Lab Financial is separate and an independent company from those two entities. So just so we can get that legalese out of the way and get right into the fun stuff. So I saw the question, what were my favorite retirement plans for the middle upper class? And, it's hard to define what is a favorite plan because it's really based on every individual need. When you're talking about people that, with different income levels and different goals, both financially, that they need to work on, then it makes not one retirement plan my favorite. It makes the strategy, whatever the strategy is that can get them the best results in the most tax efficient, creditor protected way to help them reach their long-term or short-term financial goals. So middle and upper class people are usually your professionals, your working professionals that are working as independent small business owners, executives, or upper level engineers. And that's what I consider this upper middle class. Below that higher net worth of around that 5 million and below range is what I would consider that upper middle class echelon. So there's a lot of different things for them, and it really just depends on kind of what their goal is. Is it tax efficiency? Is it creditor protection? Is it just reducing taxes? There's a lot of different ways to skin a cat in this industry, and every client is definitely unique.
Yeah, for sure. I guess really my question, relating to that question for the middle class, is what like a Roth IRA, a 401k.
Yeah.
What do you obviously, we have the 59 and a half years old for the Roth IRA. You can invest $6,000, but there is limits on those. If maybe someone in the upper middle class can't choose a Roth IRA, what are some other strategies that maybe you utilize in your business or that you really enjoy that maybe is different than a Roth IRA, or just, some additional information on top of that? I think our audience would really, find that useful.
Yeah, of course. Great question, Brendan. So when we're looking at some of the strategies that, obviously the more income you have alienates some strategies, like if you earn within a certain amount, you can't contribute to a Roth IRA. You can't get a tax deduction from a traditional IRA. So there I would like the 401k if they're employed somewhere, or if they're have their own 401k within a business ownership. We do a lot of Roth conversions within those if we want to take pre-tax dollars and convert to tax-free dollars. For that working person that still says, hey, I'd rather pay the tax devil today versus then, we do what we call a backdoor Roth, or a Roth recharacterization, or a conversion. So basically they contribute X amount of dollars to a traditional IRA and immediately convert it to Roth, so that they can do that because the IRS doesn't have income limits on those types of things. So there's always strategies and ways around. If I'm looking at the working professional, there's going to need to be a blend of both. So obviously they're, a working professional or someone who's a middle to high income earner. you know, the middle to high income earners are going to want a little bit of tax diversification. So in other words, you know, you may want to do a blend of tax deferred in a 401k or a traditional IRA if they
Hmm.
qualify, and then a little bit of Roth on top of that, because when they go to retire down the road, and even young, and guys, you're young, you know, I got a few years on you, you know, it gets here before you know it. When you get to that age where you're ready to retire,
Right.
if you have diversified your tax, then that's good. And then if there's anything above and beyond that, you know, of course, those taxable non-qualified assets, such as just buying a stock in a brokerage account kind of thing. Um, but those are some strategies, Roth conversions. But I'm a huge fan of tax diversification, because that's going to help with Social Security down the road. That's going to help keep your tax bracket lower, because let's face it, we got a lot of debt. There's eventually going to have to come a time where income tax brackets at some point will have to go up. That's pure speculation, but given the history of what it was versus what it is and where I think it's going to go, it's a fairly reasonable expectation. So,
Yeah, we're definitely
yeah.
in some very uncertain times right now economically, and they've printed a multitude of money, trillions upon
Hmm.
trillions of dollars, trying to keep everything afloat. Now we have the Fed raising interest rates. We have
Hmm.
CPI, Consumer Price Index. I think it was 8.2 or 8.4%. It's crazy to keep up with it because it just keeps continually increasing the price of goods and services. Going back to the investing in the Roth IRA.
Hmm.
I guess really my question for me personally is, as a financial advisor and very knowledgeable and in the space for a multitude of years and a lot of time, what is the number one mistake that you see people are like, okay, I know I need to earn, keep, and multiply my money and increase my return on investment. I'm going to reach out. I'm going to take that step and I'm going to start investing, and I'm going to invest with, you, Kevin. What do you see as the number one mistake that these people are going in? Maybe the mindset or what they want to do or their portfolio allocation. What is their biggest mistake when they are investing that you're seeing?
Ooh, well, I've seen a lot of mistakes, but I would say one of the number one mistakes that I have seen uh, when people bring to me is putting all their money either, like tax deferred.
Hmm.
And what this does is it may help them in the short run, but it creates a tax time bomb down the road. If you think, if I retire that upper middle class person that has maybe $1 to $2 million in a 401k and it's all tax deferred, at some point they're going to have to pay the tax on that. The IRS, is very clever in how they go about getting it. Uh, Giving you a tax bracket today versus the tax bracket down the road, it may seem like you don't want to pay some of that tax now. So, one of the biggest mistakes is putting it all in one type of tax. So, tax deferred, for example.
Okay.
Another mistake I see, the biggest mistake, is not utilizing the benefits of some of their employer sponsored plans, such as a 401k.
Hmm.
A lot of people are not even taking advantage of the full match, and that's definitely something that needs to be budgeted in their savings, because you're just leaving free money on the table. Um, and another big mistake I see is people only utilizing retirement plans in general as and not having adequate amounts of cash on hand for opportunities. Because right now, you mentioned, Brendan, this is our uncertain times. Well, this is where the money's made for a lot of
Yes,
my
sir.
smarter clients. So having cash on hand and having an adequate emergency fund, and that we can peel off a little bit of those of that cash to put it in while the markets are low. That's where the money's made. People say don't time the market; it's time in the market. That's true to a certain degree. But when you have opportunities like now, it's just understanding how your portfolio works. So that's a mistake I see: people go into cash without understanding how their investments work, putting it all in tax deferred, and not thinking about what that may do down the road, and then not having enough cash on hand to take advantage of opportunities when they come about.
Yeah,
Yeah, so
100%.
yeah,
Go
so
ahead,
kind of,
Cole.
just obviously as we're talking about, the retirement plans, and that kind of leads me to, I guess, our next question that we really had is,
Mhm.
what would be your favorite retirement plan if you were in your 20s?
Oh man. Oh, the knowledge I have now versus what I wish I'd have known back then. I've made a lot of mistakes, but if I had one retirement plan to choose from, depending, of all things considered, we were talking about just a young person that's getting their start after they have established an emergency fund. I don't care how much money they're making. If they don't have emergency fund on cash, what winds up happening is they pull from these retirement plans and face potential penalties. But if they have the emergency fund established and they're looking to invest and they're able to live within their budget, that Roth IRA or Roth into their 401k is probably the most powerful tool that they have, as well as the HSA for their health insurance. That's triple tax deferred, so, or triple tax advantage, I should say. But the Roth IRA for you guys in your 20s, tax-free investing is huge, because the longer you allow that to grow, the more valuable that decision was at your age.
So, as someone that maybe, doesn't know exactly what triple tax deferred means, can you kind of, go into that, basically explaining to our audience,
Yeah.
what is tax deferred, what are the positives of it, and, what does it really do?
So just to correct, it wasn't triple tax deferred, misspoke. It's triple tax advantage, and that's the HSA account. That's a health savings account. So you think of yourself right out of college, or you're going to go make your way out of high school, and you get handed these health insurance plans, and some of them have what they call HSA availability, which means that you have a high deductible health plan, which means you're going to come out of pocket more for your health insurance than someone who paid a higher premium and had to pay lower deductibles. So that was a little background. So if you're utilizing the HSA, you can make contributions to that HSA. For a family, I believe it's $7,200. I think for an individual, it's 31. Those numbers may have changed for 2022. I have to look at that. But basically, you get a tax deduction. It's not accounted towards your adjusted gross income. And if you use it for a qualified medical expense, it's completely tax free. And the beauty of it is it can be invested. Once you get a certain amount of dollars and cash in there, if you're a healthy person, maybe you go just for checkups, you can invest those funds and have them growing just like your other investments. But now you have it to be able to use for a Roth. It's basically a Roth IRA for healthcare. And then when you get to 65 and you enroll in Medicare, it gets taxed for anything you want to use it on as a traditional IRA. So just basically, tax deferred, or you could still use it for medical expenses and it's completely tax free. So that's what I mean by triple. So you get the tax deferral of it not being taxed as it grows. You get the tax deduction on it or the tax reduction in your gross income from your W-2 or whatever, your 1040 that goes on there. And then it also can be used completely tax-free under certain situations. So,
yeah. So I guess, since we're talking about like tax saving strategies and we're talking about, kind of just the overall, I kind of want to dive into more of, self-employed individuals and business owners. It's kind of, I guess it can get very messy in a bunch of different ways, with, the ways that you can do things correctly, the ways you can't do things. So I guess that leads me into my question, which would be, what are some of the best tax saving strategies for self-employed individuals and business owners?
Yeah, so this is going to that. This is not, I've said this a million times before and other things, that this is not specific tax advice. So I hope your readers don't think that this would apply to them. Hopefully what this answer will do is help them ask the right questions to their tax professional. For self-employed people, I'm just going to talk about the two most common things I see. Of course, there's different types of tax filings, such as S corporations, C corporations, sole proprietorships, things like that. There comes a time as a business owner where you're making a certain amount of money, and the write-offs that you get from being a sole proprietor just doesn't cut it. So your tax professional may recommend to file as what they call an S corporation. An S corporation is is probably the tax filing that is done by 99.9% of small business owners. There are some unique situations outside of that, but The S corporation allows us to take a portion of that self-employed income and separate it a little bit. So in other words, if and I'm just going to use round numbers for your listeners. Let's say you're that business owner that makes about 100,000 a year, and in your field, 100,000 is a great living. Well, a tax professional may tell you, "Hey, let's take 60,000 of that or 50,000 of that and give it to you as a W-2." And then the other 50,000 pass through your personal tax bracket. So basically, instead of paying the FICA taxes for both the employee and the employer on $100,000, you're now separating it, and you're paying those two taxes on 50,000, and the other 50,000 is coming to you in what they call a distribution or a dividend, however you want to call that, and you're only paying 7.6% or 7.62 or whatever that FICA is. So the other part of that 50,000, you just reduced that tax burden by 7.62%. Now, it only makes sense if your accountant or tax professional has run those numbers and said, "Hey, yeah, your write-offs aren't helping. This is not helping. You're going to owe X amount. You want to think about filing as an S corporation." And that could be one tax saving strategy. It's the one that I come across the most for small business owners, such as people in real estate, even small companies with less than 100 employees. That's the one biggest instant tax saving strategy that I come across when I'm making recommendations. And usually when I find somebody who is taking 100% sole proprietor, we take a look at all the pictures, and if I think an S corporation might fit, I either refer them to a tax professional or I work with their tax professional to see if that's the case.
Yeah, that was
That's
very
a good one for
helpful because
that's self-employed 101 right there. So
yeah, I love that. I appreciate that information, man. I actually did not know that stuff, and there's a lot of knowledge that you're giving our audience. So if you guys have not already done so, make sure to smash thumbs up button. Check out Kevin's links down below. Very knowledgeable dude, and we're just getting started with this podcast. But yeah, Kevin, that was really helpful because me and Cole, in the future, we're maybe thinking about becoming an S corp as we grow and we expand our business. So I thought that was very knowledgeable and really insightful as well, and the strategies and all that. So yeah, thank you for that.
No problem. And then the beauty of it, that was just the instant tax savings. You can on that W-2 side that you have to pay both the employer and the employee FICA taxes on. You can defer some of that into a retirement plan for yourself. If it's not Roth, if it's a tax deferred plan like a pre-tax 401k or a traditional IRA, not a traditional IRA, but a SEP IRA for business owners, you can further reduce your taxable burden. So I mean, there's a lot of strategies that can go along with that type of tax filing that can help out on taxes even more. So that's why we work as a team with tax professionals.
So you mentioned the SEP IRA. Is that like pretty much like a Roth IRA, but for a business, the same tax purposes and stuff?
Totally different because Roth IRA is a tax-free vehicle, meaning you're using dollars that have already been taxed to go in there. And then on that, because they've already been taxed, Uncle Sam can't double dip. So he is going to allow that to grow tax-free. A SEP IRA is very similar to a profit sharing component of a 401k, meaning based on what your annual income is, your W-2 income or your sole proprietor income, you can take up to 25% of that amount and defer that into a SEP IRA to get a tax deduction. So it's basically just a kind of, you figure out what your tax burden is. Your accountant says what you're eligible to put into a plan like that, and you put it in there and it reduces your tax burden. So a SEP IRA is a very simple, easy tool for a sole proprietor and a very beginning tool. So
awesome. Yeah, so real quick, Cole, I wanted to talk about, diving back just real quick about how imperative it is to invest in your 20s. I know you kind of elaborated on it, but I really want you to elaborate, to our audience more, maybe so they can take the grasp of it. We've talked about how, the most generational wealth is created in bear markets. It's all about, using compound interest like Warren Buffett utilized. And, how important would you say it is to really get started investing in your 20s? And why is now better than later?
That's a great question. So when you invest in your 20s, you have time on your side. That's the biggest thing. Like I can get people further in their investing goals with more time and less money than I can with more money and less time. If you're given the same person, same income kind of thing. Time also helps spread out risk. So a person of, let's say, two guys of your age, if you're investing into your Roth IRA, you can be more aggressive there because statistically, if you leave your money in 5 years, then there's a 96% chance that you're going to have positive returns. You go up past 20 years, it's a 100% chance. So you're in your 40s now, and there, no matter what the markets are doing, unless we just had this catastrophic event, you're in the money.
Yeah.
And so you can do that with more aggressive investments than you could, let's say, somebody in their 40s or 50s, that may not have as much of a time horizon. So not only do you compound longer, you spread out your risk so that now investing while you're young lowers the risk even on a 100% stock portfolio, as long as you have quality in there. So it's super important. The earlier you can get started, guys, the better, even if it's just a small amount. And this goes back to paying yourself first and paying everybody else later. So,
Yeah. So obviously we kind of, we talked about, kind of the stock side of things in order to
mhm,
do it. And, as me and Brendan like to say, we really like to diversify portfolios. We think it's,
mhm,
you got to have, a certain percentage, and everyone's different,
yep,
whether, they want to go 50-50, 25-25-25, whatever you want to do. I think it's really, important that you diversify your portfolio. That being said, we kind of want to dive a little bit into picking your brain about real estate,
okay.
right? So, for us is, how do you tell a good investment in real estate compared to an excellent investment in real estate? It's kind of just like the numbers, the specific analytic
Yeah,
tools
yeah,
that
yeah.
you use.
That's a great question, Cole, and a very it's a very difficult question to pinpoint down. So I'm just going to kind of talk about our process in order to help my clients. First off, if you're dealing with real property, that means you want to go out and buy a piece of land, buy a home, or buy a multi-unit building or something. That's different from someone who wants to invest in real estate in the markets through either opportunity zones or REITs or things like that. And REITs are real estate investment trusts. That's what those stand for. So let's just focus on and I let my team of CFAs and analysts pick out all the things that are affected by the markets, like the opportunity zones. These guys do it, every day, all day. But let's talk about real property, for example. If you're going to say, hey, you know what, I'm going to go buy a rental property, I'm going to see if it's a good investment. There's ways that I can figure out what your internal rate of return is going to be. So if a client of mine, and I'm a huge fan of real estate in a portfolio, by the way, I love them because they're like dividend producing
Yeah.
stocks, and they help diversify that portfolio and reduce the overall risk. And that's what diversification is supposed to do. So a client comes to me. I have quite a few real estate professionals in my book, and they come to me and say, Kevin, I see two properties. I'm trying to see which one is going to be better. So they give me their purchase price. They give me what their anticipated amount of rent would be if they're going to Airbnb it, if they're going to rent it, what kind of costs would go into fixing it to get it ready for what I call production, meaning someone goes in there and actually lives there or rents it out. And then what is the average growth rate of a piece of property, or an area that you're looking at? Is the market you're looking in? I look at 5 and 10 year growth rates, and I look and say, okay, what is the average rate of growth in this real estate market? And I take all that data together, and then I crunch the numbers. And what comes out is whatever the higher internal rate of return is going to be your better opportunity for investment. It may not be the prettiest property. It may not be the best looking one on the block. So there's a lot of different factors, but just going by the numbers, that's one way I look at it. So if a person tells me they have their eye on property A, and I run all of those numbers, they may get an internal rate of return of 8-10%. And they can also tell me what they want to get out of it. If they say, hey, I want to try to get a 10 or 15% rate of return on the long run, on average, year over year of this property, I can tell them right quick based on what they need to do to that property, whether it's going to be there. So that's how I do it. The only problem is right now, as you guys are well aware, we're in such a hot market. It's hard to
Yeah.
do that kind of
Yeah.
analysis.
I
So
was, yeah.
yeah, so then you got to look at the qualitative factors
And
of it.
I kind of was going to ask you with that too. You know, obviously, as you know, mortgage lenders and you know the secondary mortgage
Yeah.
market. You know, with Fannie Mae and Freddie Mac. You know, it's crazy for me. Like, you know, I was looking into doing an investment property, and I called actually a couple private lenders, and they go, yeah, it's going to be 30% interest. Not 30%, but 6 to 8% interest with 30% down. And, you know, for, you know, as we, you know, like to preach, you know, for us, a great between a good and a great investment is having that lower money down to be able to, you know, leverage the most amount of money as possible. So that way that, you know, over time you can build that, you know, basically build all that.
Compound it, right? Cool.
Kind of. That's a good strategy.
It just couldn't come out. Yeah.
No, I get it, man. We're talking about some technical stuff here, but
Yeah.
there's a couple of ways to look at it, because that is one key factor too. Is, you know, how much money do you need to put down in order to get that rate of return? Because how much you put down is going to affect your internal rate of return, and also what kind of the financing terms, if you're going to finance from a private lender or if you're going to go through a bank or institution. You know, those are, and I hope we were talking about the same thing on private lending. I was thinking about hard lending, like you go to an individual that has cash and they're going to give it to you. I will tell you this, though. I mean, you know, sometimes those higher interest rates with a little bit down can actually produce a better internal rate of return over the long term. But if you're trying to get into it and you don't have a lot of cash, just getting your foot in the door through some of those strategies where less money down, doing that just to get your foot in the door is a great way to do it. And then as your equity builds up in those properties, you know, you start leveraging your properties now in order to start financing other things. So it's no different than me taking a dividend producing stock and reinvesting that dividend back into another investment or something, or the similar investment. So you guys can take the equity on your real properties and reinvest that into a down payment without putting money down per se. You're putting a you know, leverage on your property. So, you know, but it's just getting the foot in the door is the hardest part. Once the foot's in the door in real estate investing, I think that it becomes a lot easier now, because now you have an asset on your side, whereas the only asset you have prior to that is, you know, what kind of income you have coming in, what, you know, and what are, you know, who's going to give you the money. That's really the hardest part, is getting your foot in the door. And for young people, one of the best ways I found for them to get into real estate investing is they secure their first property. And then if they're single or they don't have family or they got extra space or something like that, they lease out a room. You know, so there's a very beginning way for someone who doesn't have a lot of liquid assets at their disposal to, you know, to qualify for that first property, whether it be through a private investor or through a institution, and then rent out portions of the house. You know, it comes with its pros and cons, but it's one of the simplest ways to get started. You know?
Yeah, I agree 100%. I really love real estate, and Cole, as a real estate licensed agent in Florida, he's very knowledgeable about it. So I'm really happy we're diving into real estate. You know, obviously what I really love about real estate too is it's a tangible asset, as you said. I always tell people, think of real estate as more of a long-term game. You're going to build a relationship with that property because you're going to own it for, you know, multiple years.
Yeah.
You need to understand the ins and the outs, the location. Is it going to cash flow? You know, and not to mention, you know, as you're an expert on this, also the tax advantages of real estate are tremendous as well. So, you know, there's a lot of, that's why I really love real estate. And as you mentioned, you can leverage it. And I think, you know, real estate is really one of the best ways to build wealth as well as get those tax advantages. Real quick, before we dive into the next question, I'm curious, what is your favorite type of property personally? Do you like single family? Are you more of a commercial? What have you noticed in the marketplace? What works best for you?
Well, I think, you know, I think everybody's got to start somewhere. You know, I have people who invest in land. I mean, and that's all they invest in because they're doing the long play. because, I don't know if you guys are aware of this, but they quit manufacturing land a long time ago. So, it takes a long time to create a rock, with volcanoes and all that. Hawaii's still the only place I know that, along with the volcanoes, that manufacture land. So buying land has been a good hedge against inflation. So some people are doing that for the long play and to tax advantage it for agricultural purposes and things like that. I have other people. I think if it's a beginning investor and they don't want to like talk about, or if they don't want to deal with the long play on it and they're just wanting to get in and get something going, I don't think there's anything wrong with a single family property or a single family residence to get your feet wet. Now, when I look at the rates of return on, for some of my clients that do both, obviously the multi-unit, the commercial style properties are going to be you're more profitable because you get more volume and rents there, but your costs are fixed for the most part. Taxes are taxes, so I mean, you got property taxes there. But I think if someone's brand new at it, jumping right in, unless you're just a go-getter and understand the ins and outs of multi-unit, I think getting started with a single family residence, just a rental property, just to get the kind of understanding of the tax benefits of, because you can claim some tax benefits right away. Some things you can't claim until you go to sell the property. So there's, understanding, just what benefits of being a real estate investor can be done by a single family. And then once you're like, you got that golden next step, commercial properties. But if you're that go-getter, if you've been around commercial, if that's been like, let's say you're a property manager for one, yeah, go for it. But I think you're more profitable ones. If locations are similar, if market conditions are similar, your multi-unit, properties are going to be your more profitable ones that I've seen based on numbers.
Yeah.
But hey, man, I love those single family residents on that and that cash flow there too. So
yeah, especially with the Airbnbs in the Florida area. When you got that when you're by the beach and you got a triplex, quadruplex, and you can rent those out for $300-400 a night on the beach.
Yeah,
and
you bring up a good point there, Cole, because that also determines how you rent out your property. Can also determine, some of the tax advantages. And, I can't get into those specifics because that would be giving specific tax advice. But, if you have a location that's going to rent out Airbnb just from a cash flow perspective, those short few months where it's on can be worth more than a long-term rental year over year. So you got to know what location you're in, what it's best suited for. Before you decide whether you're going to go VRBO, Airbnb, or just make it a long-term rental. Of course, long-term rentals are a little more stable because you got a lease sign, you got contractual obligations, but the opportunity in the Airbnb in the right location can be very lucrative, and it has been for some of my clients.
Yeah, and I think once you invest in real estate and you're getting that cash flow, you're having all these tax write-offs, amortization, etc. I think once people are receiving the cash flow and they go to sell, right, then you have capital gains. Then depending on what they want to do, they can either 1031 exchange it, or they're going to save it and maybe set their family up for the future, set their kids up for the future.
Yeah.
So I guess that kind of leads me into my next question is, what are some of your favorite saving plans for people who, may have, received, more income and are on the higher tax bracket or even in the middle,
No, you're absolutely right. And I've come across this before where a very middle class person just so happened to buy a property at a very good time, and the growth of that would have produced a large capital gain tax on them. So there are some strategies that I work with on for real estate. That 1031 exchange, I'm not sure if you guys are aware of some new legislation coming out, but Biden is really pushing for capping out the cap gains deferrals on 1031 exchanges, where a single person can only defer up to $500,000 in cap gains, whereas a married couple can defer up to $1 million. Now, I don't agree with this because they've already run the data, and it looks like by allowing the ultra wealthy and all them to do 1031 exchanges at those higher cap gains liabilities produces more income into our treasury than if we just made them pay it right away and only deferred. So that's just there's my thoughts on that. But 1031 exchanges are a good plan if a person is wanting to do a like property, a similar property. Now, what is similar is very loosey goosey in terms of there, as long as it's got some, similar aspects to it. But a 1031 exchange is a good way to defer the cap gains. And I say defer because, like I said, Uncle Sam is really good at always getting his tax. He's going to get it now, he's going to get it, or he's going to get it later, but he will eventually get his tax. And it's my job to make sure he doesn't get a dime more than what is owed to him. He's going to get it. No matter how wealthy you are or anything, he's going to get it. So 1031 exchanges are good. Those are good opportunities. If a person doesn't have a property in mind to do a 1031 exchange, they can still defer those cap gains through opportunity zones. Opportunity zones are just investment funds or vehicles that allow a person to take their capital gain and put it into that fund, and it just kicks that cap gain can down the road. But what you're able to do is you're able to invest it in underdeveloped properties that are being developed. That's why they call them opportunity zones. Think of Flint, Michigan. Kid Rock, he put in a whole big investment into Flint. They're doing a lot of op zones there, but that is a great way if you're willing to tie up that money for a certain amount of time to not have to pay that gain right off the bat and use that gain to your advantage. When it's time to pay the capital gain, hopefully you've made enough to not only pay the cap gain, but put a little more money in your pocket as well. There's for those big cases, there are types of income or deferred income trusts. So I'll give you a prime example here. Let's say a person has a gain of $500,000 on a property. These are more your commercial people, your multi-unit, bigger developers. But let's say they have like a $500,000 gain on a property. You could put it in a structured trust where if you sold the property, let's say for $1 million and 500,000 was your gain, you could put that whole million in the trust, let it start working for you, get it invested. If you don't want to do real estate anymore, you could just get it invested in the markets, structured out 3, 5, 10, 20 years is the max. But you take a structured payout on it, but by the end of it, you've let the whole million work for you, not the 40% more than likely the 20% that you would have had to have deferred in cap gains. So if you 20% of 500,000, working to your advantage, that's another 100,000 right there you got working on your behalf in the markets. So there's a lot of strategies, especially for my more affluent investors and higher net worth investors, to kind of get around that paying the gain right away. If you don't need it right away, there's a lot of opportunities and a lot of tools out there, even if Biden does the limits on the 1031s.
Which I think, as an investor and somebody that, really believes in real estate, to have it in your portfolio, that would really, that'd suck.
Yeah, exactly. And the one, the reason why real estate investors still work with a guy like me, because obviously I'm market focused and everything. We look at managing real estate assets as an overall portfolio and everything, but they also understand diversification is key because you guys are a little young, but think about 2008. If we were having this conversation in 2008, all of those strategies for liquidity, for leveraging your equity to buy a property when the home values were dropped 60, 70%, you're now taking losses, and you can only carry over so many losses per year on properties, or just in general on cap gains, capital losses. You can only carry over 3,000 every year. So there's other things you can do tax wise, but the biggest problem with real estate and why it's important to diversify even is just for liquidity purposes. So if you're going to be a real estate investor, and I wholeheartedly believe in it, make sure you have adequate cash on hand to help with some of that. Because when the opportunity arises, if a fall in the real estate market happens, then you're going to need something to leverage that opportunity. And if you don't have cash on hand, you may not have any leverage on your own properties to go out and get
Yeah,
another one.
it's kind of funny that you mentioned that. So my kind of question to you is, where do you see the market right now? Where do you see it heading? And obviously there is a lot of trends and analysis data that is comparing, kind of where we are to, kind of that '07 trickling in. So what are your thoughts on that?
I've had probably, I don't know how many extensive conversations with my team of CFAs, analysts, and all that stuff. And, and we talk, and I read their commentary, and I get on the phone with them and talk to them. So here's basically the nutshell, I think, of where we're at, and just try to put it in as simple terms as possible. I don't think we are in that recession of 2008, that great recession. I don't see a lot of those underlying factors that cause that. If there's a comparison to what we kind of have going on today, and your listeners can obviously Google this, go back to the 70s when we had the oil crisis and inflation was high and the Fed had to raise interest rates, and there were lines. For half a mile or more to get gas, because inflation is caused by a simple thing. There's too many people chasing too few goods. So that's kind of where we're at right now. Supply chains were crippled during the pandemic. So, and these are global supply chains. So, whereas all these people had an influx of that free money and cash that we were talking about printing earlier, but really nothing to spend it on because, they couldn't really get out. So they put it in assets like the markets. Everybody became a professional stock picker on Facebook and, from meme investing and all that stuff.
Yeah.
Now they see why, having good fundamentals is so important on investing. But where I think we're headed. So here's what's going on in the markets right now. So inflation is high. Like as Brendan said, we're at that 8.3, 8.1 range on that consumer price index. That inflation rate is kind of where we're at. The Fed wants to get us down between 2 to 2.5%. That's the goal. And they're going to do whatever power they have to get us down to that goal. So I don't see a recession happening because the economy is actually doing really well. Where I do see an issue is in the labor markets because there's too many jobs. We created over 150,000 jobs, I think, in the last labor report, but there's just not enough people to fill them. We still have some global supply chain issues from other countries that we get raw resources from and raw materials from to produce.
Yeah.
They have to raise the interest rates, and obviously that's going to cool off the housing market. That's going to cool off. The monetary easement we've had. As a matter of fact, Jerome Powell even said he's more leaning towards it being restrictive. And just so people know, your readers know, the Fed's funds rate is what's being risen right now. And they dropped it down to zero because of the real estate crisis in 2008. They dropped it all the way down to zero. And what that does is just allow banks and institutions to borrow money very easily. And because of that, they were able to lend it out at very low interest rates. So you got those mortgages at 2.5%, 3%, 3.5%. Man, we're riding that gravy train with biscuit wheels as long as possible. Okay.
Yeah.
But now that Fed funds rate is going up, and they're doing that because they have to bring inflation down. And if they don't do that, then the economy could collapse. We could have a very serious issue. Now, what they're having to balance is how much are they going to raise it by, and how often until they get to that goal of 2.5%. And what you've seen in the last couple of days, the markets have been up, and markets are an indicator of the economy. So as long as there's some consistency in the Fed, then there's been consistency in the markets, and it's an indicator our economy is still healthy. But now that they're saying, hey, 50 basis points is kind of where we're headed on some of these increases, that allows people to invest and be a little more, plan a little bit better as they're putting money back into the markets. But economy's healthy. Fed's funds rate is raising. They're going to raise it as much as they can to get that inflation back down to 2.5%. And the reason why it was that funds Fed rate was zero for 14 years is because that inflation was on average 2.5%, because we didn't have a supply and demand issue. So. Hope that.
Yeah, I know that obviously the Fed controlling interest rates is very important, and as inflation is at a 40-year high since roughly the 1980s, they're
Yep.
going to have to continue to raise rates. I agree with some of the a lot of the things you're saying. It's going to be interesting to really see what unfolds. Like you said, we have very high price of goods and services, especially in fuel.
Hmm.
Which is, it's costing more people money. They don't have as much disposable income. And then with the Fed tightening these rates, people are going to have less drive to go out and make investments and do those things because it's going to cost them more money to, let's say, buy a real estate property,
Hmm.
unless they have, a large war chest or capital. As you said, that's also very important because,
Yeah.
as you said before, investing when the market down is really the best time to increase your return on investment on the way up.
Hmm.
So yeah, I really appreciate that information. I can't agree anymore about the Fed having to continue to raise interest
Yeah.
rates because bottom line is they need to get inflation under control, and they're
That's
going
right.
to do whatever they can in their power to do so.
That's right. And there's still opportunities because if you think about it, even though the interest rates are rising and people aren't used to seeing higher mortgage rates, there's still opportunities. We're still historically low comparative to what they were. Real estate guys. You go back, into the '80s and the '90s at what it took to get a mortgage. I mean, they were doing mortgages at 12%,
Yeah.
15%. So the Fed funds rate does not directly, affect the mortgage interest rate, but it is indirectly affected, and that is because as banks are borrowing money from from these from the reserve and from each other at the Fed funds rate, then if it's higher for them to borrow it, it's going to be passed along. So there's still some opportunities out there, and that's when now that the markets are cooled off, you do have to be very selective as to which property you're going to buy, which where what's the long-term trend of that property and what's your goal for that property. If it's just a cash flow goal, there's more opportunities than if you're looking for something that's going to give you an X amount of return over a certain amount of years. So I think it's going to help serious real estate investors, because it will cool off the people that are just out there willy nilly buying houses, and just or people moving in and saying, "Oh well, I could borrow $450,000 back, a few months ago, but now I can only borrow 200,000." So that's
Yeah.
going to limit the inventory that they're able to shop from, which is going to allow for serious real estate investors to start doing a little more analysis, getting some better data before they just buy up a property. So, still some
Yeah.
opportunities out there.
Yeah, 100%. So, kind of, wrapping it up a little bit
Hmm.
here, as a financial, educator
Hmm.
and a very experienced advisor, what would you tell yourself in 20-year-old if you had the knowledge you have today?
Well, I will tell you, man, I worked a pipe foundry job when I was going through college. I grew up farming and everything. And I'm only saying this as a backdrop because you're going to hear the biggest mistake I think I've ever made in financially. And so I had a big work ethic. So I'd go work 16 to 18 hours a day and, crush two fingers because of it, because I worked a 20-hour day one day and was a little tired. But those summers, I worked 3 summers and I made $15,000 back in the late '90s, early 2000s. I was in my 19, 20, 21 range. And so you look at a 3-year time span, $45,000 went into my pocket as a 20-year-old something, still in college. And I pissed every bit of it away on having a good time, buying things, making people want, having big parties and doing all that. So if I had one thing to say is get an emergency fund, treat it like it's gold that you never want to get rid of. The second thing is don't go broke trying to appear rich in front of your friends. All right. Invest. If it's $25 a month, $50 a month, you do that in your 20s. By the time you get to your 40s, when all your friends are finally catching up to, hey, we need to start saving, you can go buy that lake house. So that 3 summer job that I had, and I do a little, what we call a rule of 72. I take the number 72, divide it by the rate of return I hope to get. And if I would have gotten an 8% rate of return from the days I got that 45,000, I would have been able to pay for my lake home in cash. So That $45,000 mistake I made cost me what I'm still saving for and about leveraging, or looking for right now in an inflated market. That $45,000 mistake cost me my lake home, cost me a future that would be, I could probably retire a lot earlier. Instead, I went into teaching for 11 years. So, I didn't make any money there.
Yeah.
So I say, if I had to look at my 20-year-old self, it's not about impressing your friends. It's not about what you own. It's about what you're trying to accomplish. And let that drive you first. Let that guide your financial decisions first. And then what's left over, impress your friends. And if you have to impress your friends with money, they're not your friends. So exactly. So invest as little as you can. Think always pay yourself first and keep it yourself first. Okay. So get an emergency fund established for whatever your goal is that you're trying, whether it be moving out of the parents' house or, getting your first place for college or whatnot. Get a healthy emergency fund. But then after that's established, if the bare minimum is only $25, $50, start putting it in some sort of investment to grow an asset on your behalf. And then when you get to that point, man, that's when you can start popping into real estate.
Yeah.
Amen.
So, yeah, guys. Awesome.
Yeah, I think, going back to what you were saying, Kevin, and I can't agree anymore, is we see a lot, especially in, our society and with millennials, that they want to try to look rich instead of, actually having wealth and investing in their future. And I tell people all the time, I've talked to, a lot of people just at my college and really just like even some friends, you need to start getting invested now. They're like, well, I can start doing that when I'm 30. I'm like, dude, time is your best asset. You need to use time to your advantage so you can generate the compound interest. If you wait 10, 15 years, you're losing, instead of making 1.5 million in a Roth to maybe $5 million if it compounds at 12% return. So I try to tell, get in the market. Like you said with real estate, it's all about just stepping in that door, learning the ins and the outs, and putting your money in an asset vehicle. And then if you want to buy those luxury items, do it off your passive income from your asset vehicles that you can also write off and you can leverage against. So, I think that, that is really knowledgeable. I'm happy that our audience got to hear, from your point of view and how imperative it is to get in the market, how important, using tax benefits are, why, it is to invest the right way in different asset vehicles. And don't go broke trying to look rich, and instead try to invest in assets and live off your passive income. So I really appreciate the show today. I think we covered a lot of things. Cole, I don't know if there's anything else you want to dive into, but again, guys, we will leave all of his links down below. If you enjoyed having Mr. Kevin Chancellor on the show, make sure to smash thumbs up button and check him out as always, and leave a comment what your opinion was on this podcast. Anything else, Cole, you want to add?
Yeah, just let me know just let us know down below kind of who you want next or what do you want to see, and we'll make sure to get it to you guys.
Yeah. Hey, I appreciate the opportunity, guys. I'm glad to be able to help educate some of your listeners, man.
Of course. Thank you. Thank you for your time.
Thank you, sir. It was good having you, and you guys have a good rest of your day. Thank you for watching the podcast. Peace, brothers.
Later, guys. Take care.